Money can be a blessing or a curse. It all depends on how you handle it. Imagine being 60 years old and realizing you could have lived differently if you'd avoided a few key mistakes. Some financial choices haunt people for decades. But here's the good news. It's not too late to avoid these pitfalls. Today, we'll count down 10 money mistakes people regret later in life. Each one could cost you big, but the last one, it's a game changer. Ready to future-proof your finances? Let's dive in. Mistake 10, procrastinating on estate planning. Let's start with a tough one, estate planning. Most people put this off because, well, who wants to think about death? But imagine leaving your family to deal with chaos because you didn't take a few simple steps. Without a will, your assets might not go to the people you love. Family feuds over inheritances? They're all too common. Even worse, your estate might get stuck in probate for months or years. Solution? Create a will. Include a power of attorney and a healthcare directive. It's not just about protecting your assets. It's about protecting your loved ones from unnecessary stress. Mistake 9, not seeking professional financial advice. Money is complex, and unless you're a financial expert, chances are you're leaving money on the table. Think about it. How confident are you in your retirement planning, your investment choices, your tax strategies? Maria thought she had it all figured out. She saved diligently, avoided debt, and even invested. But when she finally consulted a financial advisor, she learned she was missing key opportunities to grow her wealth and save on taxes. Adjusting her portfolio and contributions completely changed her outlook. The bottom line, professionals see the blind spots you don't. They'll help you navigate the maze of retirement accounts, investment strategies, and tax laws. And with so much at stake, it's a small price to pay for financial peace of mind. And mistake 8, succumbing to lifestyle inflation. It's easy to let your spending grow with your paycheck. You get a raise and suddenly that modest car doesn't seem good enough. You're upgrading your wardrobe, moving into a fancier apartment, and dining at upscale restaurants. It feels good, but is it sustainable? Lifestyle inflation is one of the sneakiest ways people sabotage their financial future. Before you know it, you're earning 6 figures, but still struggling to save. Eric, here's the solution. Treat raises and bonuses like opportunities to build wealth, not excuses to spend more. Set a rule for yourself. Allocate at least 50% of any increase in income to savings, investments, or debt repayment. Reward yourself a little, sure, but don't let your future self pay the price for today's indulgence. Mistake 7, ignoring the impact of taxes on investments. Taxes can quietly drain your wealth if you're not careful. Imagine saving and investing for years, only to see a huge chunk of your returns vanish during tax season. It's frustrating and avoidable. Let's say you sell an investment after holding it for less than a year. You'll likely pay short-term capital gains taxes, which are much higher than long-term rates. Or maybe you're not using tax-advantaged accounts like IRAs and 401(k)s to their full potential. These small missteps can add up to big losses. The fix? Get familiar with tax-efficient investing. Hold assets for the long term to minimize taxes and max out contributions to tax-advantaged accounts. If this feels overwhelming, consult a tax professional. Remember, it's not about what you earn, it's about what you keep. Mistake 6, not having adequate insurance. Insurance feels like one of those expenses you'd rather skip, right? It's tempting to think, that won't happen to me. But what if it does? A hospital stay, a car accident, or a house fire could destroy your financial stability overnight. Take Rachel, for example. She skipped health insurance to save money. Then she broke her leg and faced a $25,000 hospital bill. Without insurance, she was forced to take on crippling debt. Health insurance, auto insurance, and homeowners or renters insurance aren't optional. They're necessities. Life insurance is also crucial if you have dependents. These policies protect you from life's unpredictability. Sure, premiums can be a pain, but the alternative? Financial devastation. Mistake 5, neglecting to invest. Saving is great, but saving alone won't build wealth. Inflation eats away at the value of money sitting in a savings account. Investing is the key to growing your wealth, but many people avoid it out of fear or lack of knowledge. Let's break it down. Imagine you save $50,000 over 10 years in a traditional savings account with a 1% interest rate. You'll earn about $5,000 in interest. But if you invested that same amount in a fund averaging 7% returns, you'd end up with over $96,000. That's the power of compounding. The best part? You don't need to be an expert. Start with index funds or ETFs, which are simple and low cost. Even small, consistent investments can grow into something significant over time. Don't let fear keep you on the sidelines. Mistake 4. Accumulating high-interest debt. Debt is a silent killer of financial dreams. It starts small, a credit card swipe here, a payday loan there. But with interest rates as high as 20% or more, it doesn't take long for manageable debt to spiral out of control. Take Sarah, for instance. She used her credit card to cover everyday expenses, thinking she'd pay it off soon. Fast forward 5 years, and she was $15,000 in debt, paying over $3,000 a year in interest alone. How do you escape this trap? Start by tackling high-interest debt first. Use the snowball method, paying off the smallest balances first, or the avalanche method, paying off the highest interest rates first. And moving forward, if you can't afford to pay cash, ask yourself if you can really afford it at all. Mistake 3. Failing to build an emergency fund. Life doesn't come with warning signs. One moment, everything's fine. The next, your car breaks down or you lose your job. Without an emergency fund, these surprises can push you into debt. Even a small emergency fund can make a huge difference. Start with $500. Once you hit that goal, aim for 3 to 6 months worth of expenses. Keep this money in a separate, easily accessible account. It's not for vacations or shopping sprees. It's your safety net for life's unpredictable moments. Mistake 2. Living beyond your means. Social media makes it worse. You see people with designer clothes, luxury cars, and dream vacations, and you feel the pressure to keep up. But here's the truth. Many of those people are drowning in debt. Living beyond your means creates a cycle that's hard to break. You spend more than you earn, rack up debt, and then use future income to pay it off, leaving no room to save or invest. The solution? Create a budget and stick to it. Separate your needs from your wants. And remember, the goal isn't to look rich, is to actually be rich. Mistake 1. Not starting retirement savings. Early, or here it is, the game changer. Retirement might feel far away, but the earlier you start saving, the less you'll have to worry later. The secret is compound interest, where your money earns interest on the interest it's already earned. Let's compare two people. Jane starts saving $200 a month at age 25. By the time she's 65, she has over $500,000. Mike starts saving the same amount at 35. By 65, he has just $250,000, half of what Jane has. Even though they both save the same amount monthly. Don't wait. Open a retirement account, even if you can only contribute a small amount. Your future self will be grateful you started when you did. So, which mistake are you fixing first? Let us know in the comments below. If you found this video helpful, like it, share it, and subscribe to our channel. Don't forget to hit the bell icon so you're the first to know when we drop more tips for a financially secure life. Your future is waiting. Make it a bright one.